Since my last video, I have got at least 50 such comments asking me, Alok, what is the difference between SWP and IDCW? Can you explain us how they are different? Because we know about SWP because that's sort of like popular on YouTube. But what's exactly about the IDCW option and which one is better? And I saw many people giving some misleading comments, okay, no, IDCW is not better or SWP is always good. But then the whole purpose of this video is to first give you a clear clarification of what SWP is and how it is compared to IDCW. And in the second part, I would want to show you real numbers of a mutual fund and how these two options differ in case of an exact mutual fund. If you see, this is the first table that I'm going to show you. And then I'm also going to show you a whole mutual fund Excel workout from where you will be able to understand the actual numbers and the actual returns that people end up making. Now, before I jump into that, you need to understand how mutual fund works. And it's very simple. Imagine like you're investing into a share. You invest X number of shares. Let's say you buy 10 shares and every share is worth 10 rupees. So you are investing 100 rupees, right? So now you know the value of the share and how many shares you have. Similarly, in mutual fund, you buy mutual fund units and you know what is the value of that mutual fund, which is called as NAV. Now, the clear distinction in both of these situations is whenever you make any lump sum investment into mutual fund, be it IDCW or SWP or a growth mode for SWP, their NAVs are different. So for IDCW, the NAV is different, and for growth option, the NAV is different. Now, when these both investments are done, you get a certain number of units allotted. Now, the reason why you need to understand this is in SWP, when you're withdrawing money from growth mutual fund plan, you are actually selling some of your mutual fund units every month, right? So your NAV of the mutual fund might increase. For example, the price of your shares might increase, but whenever you're withdrawing, you need to sell some of the shares or some of the mutual fund units. That's how you need to understand this. But in case of IDCW, which was earlier called as dividend option, the number of shares are always going to be the same. It is the dividend that gets paid out to us. And like you know, in case of shares also, whenever any dividend is declared, the new price of the share reduces by approximately the same value of the dividend which is declared. So for example, if you have shares where the value is 100 rupees and the company declares 2 rupees dividend per share, that means next day you will get 2 rupees with you, but the share price can go to 98. But if you want to withdraw money and there is no dividend, then you might have to sell some shares and then pull out money. Similarly, just giving you analogies, I'll also explain you in detail when I show you the detailed computation. But you need to understand that in IDCW mode, the number of units are going to stay the same. The NAV will fluctuate a lot. In this case, the NAV might be stable, but the number of units are removed. So coming to our comparison table, in case of an SWP, when you are pulling out money from growth mutual fund, you can decide how much you want to pull out. You can decide the frequency also of that mutual fund. But when you are opting for an IDCW mode, the fund house decides how much money they will pay you and at what frequency. Some IDCWs are quarterly IDCWs, some are monthly, some are annual. So the fund decides what kind of IDCW they want to give to you. You don't have a lot of flexibility. Similarly, in terms of cash flow predictability, whatever SWP you are setting, you know definitely that money is going to come what may. There is no objection about what money might come to you. But in case of IDCW, because the fund house is going to decide on your behalf, you are not sure whether the money will be same or if it will come or not. You take situations like COVID, where many mutual funds who were giving higher dividends, they reduce their dividends. But there are other mutual funds which we spoke in the last video also, which have a very consistent history of giving you dividends. And again, I'm going to call this dividend because earlier the name of this kind of setup was dividend and now it has been changed to IDCW. But for ease of your understanding, I'm going to continue calling it dividend. Also, if you are new to this channel, my name is Alok Dubey. I am a certified financial planner here at Prime Wealth, and we are a firm who helps people and NRIs mainly invest in make right investments and manage their wealth in the best possible manner. So coming to the topic again about the tax treatment. In case of SWP, where the mutual funds are in growth mode, the tax applicable is called as capital gain tax. As we know, in capital gains, there are long-term capital gains and short-term capital gains. So if you are holding your investment for more than 1 year, you will be subject to 12.5% of capital gains, but there is a 1.25 lakh rupees worth of exemption every year. In case of IDCW, whatever dividend you are going to receive in your account, or if you're reinvesting, that will get added to your total income in that year and you will be taxed as per tax slab. That means if your income stays below 12 lakhs, you end up paying zero taxes. If your income is higher than 12 lakhs, then you are subject to the marginal tax slabs. And this slab is slightly different for NRIs, which we can maybe discuss later. But you need to understand, no matter what amount of SWP you do, you are only subject to long-term capital gain taxes. In case of dividend, it will only get added to your income and it might or might not shoot up your marginal tax slabs. Now, about tax slab sensitivity, it doesn't matter in case of growth plan and SWP what your income tax slabs are, because you are going to be taxed flat 12.5% on the gains. But in case of dividend, it is going to be variable. Similarly, if you see the NAV impact, the number of units are reduced whenever you do any SWP, but the NAV usually stays the same. In case of IDCW, the NAV reduces the next day when you receive the dividend. It's called as ex-dividend NAV. In case of customization, you can decide what kind of frequency you want the money at, monthly, quarterly, annually. You can decide the amount, change the amount, stop things, right? It's very flexible. But in IDCW, like I said earlier, AMC controls everything. You cannot decide what to do with it. As far as taxation thing is concerned, like I again said, the first falls under capital gains and the second one falls under other income sources. In case of retirement planning, yes, I mean, it's good for retirement planning, because if you are somebody who wants to increase and decrease, it is helpful for you. In case of IDCW, the yield stays same. So if you want an inflation adjusted income, it will be hard for you to get from a IDCW scheme. So you might have to make more investments so that your IDCW increases. There's one psychological bias also. Case of SWP, because you are selling units every month, it feels like you are going to lose out on the capital and that fluctuation might be very higher. But in case of dividend, it feels like a bonus income or a dividend where your corpus more or less stays the same and you get an additional money credited to your bank account. Consistency across fund types. That means you can do an SWP from equity funds, debt funds, hybrid funds, anywhere. But in IDCW, not all mutual fund offers IDCW option, let's say reinvest or payout, because the fund structure has to be in a certain stable and balanced manner for them to be able to give you a dividend. So typically if you see only hybrid funds, balanced advantage funds, multi-asset funds, they have IDCW options. Not all mutual funds have. And even if let's say they have, they might only give you like once a year, and that might be very inconsistent also. There are some misconceptions about SWP. People think that they'll exhaust their capital too fast. That's not the case, because here in growth mode, your NAV increases at a slightly faster pace. People think that in case of IDCW, it is dividend, so it's like free money and our money is not getting impacted. That's not the case. The moment the dividend is declared, next day the NAV reduces by the same number. So it's basically you are getting your own profits redeemed every month in form of dividend and in form of consistent income. As far as capital erosion is concerned, if in case of SWP, if your withdrawal rate is more than the growth rate of your money, you will end up depleting your corpus, right? So if you kept some money, if you want to withdraw higher amounts, let's say your corpus is giving you only 10% returns, but you want to withdraw 1% a month or 12% per annum, you will lose out on the capital. But in case of IDCW, capital erosion can never happen, because the mutual fund decides how much dividend they want to give you, and they will never give you dividend more than what kind of profits or growth they are able to generate for your portfolio. Growth of capital, it happens in both the cases. It might be slower in IDCW because you're getting profits already in your bank. In case of SWP, the growth might be slightly higher because you're only withdrawing fixed amount every month. So, but it happens in both the cases. Compounding effect, there's no impact. In both the cases, it is going to be the same. If you reinvest the dividend back into the fund, or if you keep the money in growth mode, there's no impact with the compounding process. Who is SWP not suited for and who is IDCW not suited for? People who don't understand SWP don't do SWP, and people who don't understand IDCW, please don't do IDCW. So I mean, if you don't understand these structures, don't just follow advice online and get started with whatever you see, right? So I mean, this was the broader comparison. And now let me bring you to a real scenario with real numbers. In this case, I have taken a very well-known, a very renowned mutual fund, a mutual fund which has more than 1 lakh crore and has a very consistent history of giving dividends to its clients. The fund's name is HDFC Balance Advantage Fund. So I have taken the IDCW mode, and I've also taken the growth mode, because IDCW will be giving you dividend and growth mode will be used for SWP purposes. Now we have taken an example. Let's say an investment was made into both of these funds, both of these schemes. In both the cases, it was 3rd of April 2023. Now, because like I said in the beginning, the NAVs for both of these schemes will be different. So in case of growth, if you see, the NAV was 324, and in case of IDCW, the NAV was 26. So on a 1 crore investment into both of these funds, the first case, because the NAV was less, you got a lot of units, and in second case, because NAV was higher, you got less number of units. But it doesn't matter, because at the end of the day, your amount or your growth is going to be the same. So how do you find the current value of any investment? You multiply units with the current NAV. Now, if you see the dividend mode, you made investment on 1st of April, and because it's a monthly dividend kind of scheme, they give you 23 paisa per unit as dividend every month. So because we had 334 units and we got 23 paisa per unit, the dividend that we received that month was 76,800. So on a 1 crore investment, you start getting 76,800 per month. There's no restriction. Immediately the day if you make the investment 5 days before the dividend getting declared, you are definitely going to receive the dividend for that month also. Like I said, because in dividend mode, the dividend is received per units and we are not selling the units. So the units will always remain constant. If you see till date, the units are constant. The dividend rate is 23 paisa per unit, and the NAV might increase depending on how the markets are performing. Similarly, in case of growth mutual funds also, if you see, the NAV grows faster, but on every withdrawal, the units are getting sold while doing an SWP. So in this case, when we made the investment, the NAV was 324. We had 30,000 units, and every month to withdraw 75,000 rupees, we had to sell some units, and the amount of units to be sold kept on changing because the NAV also kept on increasing. Based on this, if you see the first option where we are getting a dividend of 76,800 per month, and the second case we are withdrawing 75,000. Now this 75,000 we can keep constant because it is something up to us. So I've assumed that this is a 2-year-old investment and we are going to withdraw only 75,000 every month. In this case, because the AMC controls the dividend, initially they were giving 76, then they started giving 73. Initially it was 23 paisa per unit, and then it became 25 paisa per unit. So like I said, it is up to the AMC what kind of dividend they want to give to you. Now if you see the current value of the investments, right? In both the cases, even after you are doing an SWP or you are taking dividend, always kept on increasing. In some case it was faster, in some case it might be slower, but typically your corpus is growing by the same rate because you are withdrawing somewhat the same amount every month. Now, cutting down to the situation today, if you see as of 2025, this month the IDCW option NAV was 39, where we started at 26. And in case of growth, we started at 324 and the NAV currently is 500. So the growth in NAV is very high in case of growth mode, but it's not that high in case of dividend mode. Why? Because we are withdrawing more dividend every month. But having said that, here because the number of units are constant, if you see, you have 334 units, the NAV is 39 rupees. So the current value of your investment is 1 crore 30 lakhs. Right? So you made an investment of 1 crore, the current value is 130, and the total of all the dividends that you have received till date is 23 lakh 60,000 rupees. So your current value is 130 and you have also received dividends worth of 23 lakhs. So your 1 crore in 2 years grew up to almost 155. Now, before I jump to the next part, I see many people say, oh, this is a bull market, you will not get this kind of returns. For those kind of people, I just want to mention one thing. Indian markets have given literally zero returns in last 10 months. From last September, where the markets were 26,000 as Nifty 50, the current Nifty 50 values are around 24,800 and 25,000. So literally markets have given zero returns in last 1 year. And this computation is of 2 year time horizon. So 1 year the markets might have done better, but the next year it has literally done zero. And even after that, these are the kind of returns and growth that people have received. So coming back to the point, if you see in dividend mode, the current value of the investment is 130 and total dividend received is 23 lakhs. In case of growth mode, if you see, the NAV is 516, but because we were selling units from 30,000 units, we have now come down to 25,000 units only. And if you multiply both of these, the value is again 130 only, right? So in both the cases, be it IDCW or be it SWP in a growth scheme, you are left with 1 crore 30 lakhs only in both the situation. The only difference is you kept on withdrawing 75,000 here for at least 2 years. So your total withdrawal is 21 lakhs. So the value is 130, the withdrawal is 2175. So in total, this value is around 1 crore 51 as of total received amount if you were to withdraw the money today. In this case, the total withdrawal is almost 2.5 lakhs more than the SWP mode, and the final values are same. So isn't it fascinating, because most of the people in the comment were saying, no, it's not tax efficient and all, right? If you see this table, because this income, and if you see today's value, assuming this is done by a person whose income tax is below 12 lakhs, this person in IDCW ends up paying 0 taxes on this entire income. In case of SWP, if the person's income tax slab is below 12 or above 12, doesn't matter. He has to pay flat 12.5% tax on the gains that he made on his growth scheme. But if you are somebody who is already in a higher tax slab, and if you take a dividend of 23 lakhs, you might straight away end up paying 30% tax on the dividend that you totally withdraw. So if you are somebody who is high income guy, you should always opt for SWP option, even though you can see the returns are less, but your post-tax returns might be very high. But in case of IDCW, even if it shows that you are getting very good amounts of dividend, you might end up paying higher taxes if you are in the higher tax slab. So the way I try to look at it is, if effective tax that you are going to pay on your entire wealth is 12% or below 12%, always go for IDCW. But if you are somebody who falls in 15% or 20% tax slabs, always go for SWP, because your post-tax returns in case of SWP are going to be better in that case. So that's it from my side. Again, if you are an NRI who is watching this video and wants to get something like this, please feel free to reach out to us. You can schedule our free discovery meeting on our website, for which the link is in the description. And to get such more updates, please join my NRI only WhatsApp community, for which the link is in the description below. And any of my viewer, if you still have any doubts about IDCW and SWP, please do let me know in the comments, and I'll make much more detailed video going ahead where I can show you more bigger histories of 7-year dividends or 10-year dividend history and how that money grows. Thank you, and I'll see you in the next.